Have you ever found yourself, scrolling through just tons of investment options
Hmm.
and feeling that familiar wave of overwhelm just wash over you? Maybe you're really keen to build your wealth, get genuinely well informed, and quickly.
Right.
But you just can't stand the jargon or that nagging feeling that you basically need an advanced finance degree just to figure out what's going on.
Yeah, that feeling's pretty common, I think.
If that sounds familiar, then you are absolutely in the right place. Because here at the Deep Dive, our whole mission is to give you that shortcut to becoming genuinely well informed.
Yeah, we try to cut through the noise.
Exactly. We pull out the most important nuggets of knowledge, those surprising facts, from a whole stack of insightful sources, so you don't have to, wade through it all yourself.
And building on that, today we're tackling a really fascinating and I think often misunderstood part of the investment world, exchange-traded funds,
Yep.
ETFs.
ETFs, right.
Our goal for this deep dive is to completely demystify these incredibly powerful investment vehicles. We want to make them simple, basic, really easy to understand for anyone.
Regardless of background.
Yeah, regardless of your investing background or, frankly, how much time you have.
Yeah.
Think of this as your essential guide.
I love that. Because here's where the intrigue really kicks in, I think. ETFs are constantly talked about as combining, the very best features of individual stocks and traditional mutual funds,
That's common pitch.
offering both diversification and this incredible flexibility. But what does that actually mean for you, the everyday investor? Someone looking to make smart choices without getting lost in all the weeds.
Yeah, let's really get into that.
Let's unpack it.
Yeah.
So, to kick things off, let's start with the absolute fundamentals. What exactly is an ETF?
Okay, the basics.
At its heart, an ETF is an investment fund. It holds multiple underlying assets. Picture it like a carefully curated collection, right? A diversified basket of securities.
The basket. Yeah, that's a good analogy.
But here's the crucial differentiator. The thing that puts the ET squarely in ETF, it trades on a stock exchange,
Just like a stock.
just like an individual company's share. And that exchange-traded part, it's profoundly significant. Unlike mutual funds, which you can typically only buy or sell, once a day?
Once a day after the market closes, yeah.
Right, after the close. With ETFs, you have the flexibility to buy and sell shares throughout the entire trading day,
All day long.
which means their prices fluctuate constantly in real time, just like individual stocks do.
That's a perfect way to set the stage. And, to really grasp the core identity of an ETF, I like the building blocks analogy.
Okay.
Imagine a set of building blocks. Each individual block could represent something very specific. Maybe a single iconic company like, say, Apple,
Okay.
or even an entire country, let's say Mexico.
Right.
Now, when you group these blocks together, they don't just form a random pile. They create a larger kind of cohesive structure. That structure is your ETF. So if you group a bunch of technology company blocks together, you've basically built a technology industry ETF.
Makes sense.
Or if you assemble blocks from several countries within a particular region, you get a continent-specific ETF, maybe one focused on Latin America.
Okay.
This basket or collection approach, it inherently bakes in diversification right from the start, for the moment you invest.
Right, so you're not putting all your financial eggs in one, fragile basket.
Exactly. You're spreading them across many right from your initial purchase.
So it's instantly diversified, which is, that's a massive benefit for anyone, right? Whether you're just starting out or maybe looking to simplify and strengthen an existing portfolio, that built-in risk management sounds invaluable.
Absolutely. And the sheer range of what these baskets can track is truly remarkable. It offers an incredible breadth of investment opportunities.
Like what?
Well, you can find ETFs that track something as specific as the price of a commodity like gold.
Oh,
Or a really broad, diverse collection of hundreds of stocks, like those in the S&P 500 index. There are even ETFs designed around highly specific investment strategies, like focusing on dividend-paying companies or, say, emerging markets.
huh.
For instance, the very first U.S. ETF launched way back in January 1993. That was the SPDR S&P 500 ETF, famously known by its ticker SPY.
SPY, yeah, the spider.
That's the one. It was meticulously designed just to track the performance of the S&P 500 index. Imagine, before SPY, trying to get instant diversified exposure to the whole S&P 500.
Oh, that would have been incredibly complex.
And expensive, especially for an individual investor. SPY basically democratized that access overnight. It was a truly groundbreaking shift, really opened up new avenues for countless investors.
And what about the rules? Are they regulated like other investments?
Oh, definitely. And that's reassuring, right?
Yeah.
ETFs must be rigorously registered with the SEC, the Securities and Exchange Commission,
Okay.
and they're generally subject to the robust guidelines of the Investment Company Act of 1940.
The 40 Act.
Exactly. So that regulatory oversight provides a really critical layer of investor protection and ensures transparency. Most ETFs are structured as open-ended funds.
What does open-ended mean exactly?
It just means there isn't a fixed limit on the number of investor shares that can be created or redeemed. The fund can basically grow or shrink with investor demand.
Got it. Okay, so we've got the core concept down. An ETF is a diversified basket of assets, trades like a stock all day long. That instant diversification sounds amazing for simplifying things.
It really is a key benefit.
But what's truly fascinating, I think, is the hidden engine, what makes it all tick. How do these baskets actually get created and traded in a way that keeps their price so fair and, in line with what's actually inside?
Yes, the mechanics.
Because when you buy a share of, say, that Vanguard Consumer Staples ETF, VDC,
Yeah.
you're not directly owning individual shares of Procter & Gamble or Coke, right?
Great. You own a share of the fund.
Right, a share of the fund itself. And that fund then holds those underlying company shares. So you're basically buying a piece of that entire diversified basket, and the price of that piece fluctuates all day, responding to real-time market demand. Totally unlike mutual funds where you get that one static price at the end of the day.
Exactly. And this is where it gets, well, really interesting. And frankly, it's one of the most innovative and brilliant aspects of ETFs.
Yeah.
Their unique two-layer liquidity system.
2 layers.
Yeah, and the clever arbitrage mechanism that ensures their prices stay closely aligned with the value of what's inside. You see, there are two distinct markets operating here, kind of in tandem.
Okay.
First, you have the primary market. This is where the really big players operate. We call them authorized participants, or APs.
APs.
Yeah, think of them as very large institutional investors or big broker-dealers. They interact directly with the ETF issuer, the company that created the ETF.
Directly with Vanguard or BlackRock, say.
Exactly. And they deal in massive blocks, often tens of thousands of shares at a time. These are called creation units.
Creation units. Oh.
And this process is usually done in kind. That means the APs don't just swap cash for new ETF shares. Instead, they exchange the actual underlying securities, like a precise basket of Apple, Microsoft, Amazon stocks for newly minted ETF shares.
Yeah.
Or they do the reverse when redeeming shares.
So they're literally trading baskets of stocks for baskets of ETF shares.
Pretty much, yeah. In huge sizes. And this in-kind exchange, that's actually a key factor in the ETF's tax efficiency, which we can definitely circle back to later.
Okay, interesting. So the big institutions are dealing directly with the fund, swapping actual stocks for ETF shares in these massive batches. It sounds incredibly complex on their end.
It is complex for them, yes, but it's absolutely crucial for the ETF's, seamless operation. Now, for you, the everyday retail investor.
That's me.
Right. You primarily operate in the secondary market.
Mm.
This is the familiar world of stock exchanges, the New York Stock Exchange, NASDAQ, and so on.
Where I'd normally buy shares of, say, Google or Ford.
Exactly. You buy and sell ETF shares on these exchanges throughout the trading day, just as you would an individual stock.
Yeah.
The vast majority of retail investor trades, almost all of them, really happen right here in this secondary market.
I'm just trying to wrap my head around that arbitrage mechanism you mentioned. It sounds really clever how it keeps things balanced, but how does this whole two-tiered system make sure that the price I see on the exchange, on my screen, is actually a fair reflection of what's inside that ETF basket? Couldn't the ETF's price just drift way off from the true value of its holdings?
That's a really crucial question, and it's brilliantly addressed by the arbitrage mechanism. That's truly the secret sauce of ETFs.
The secret sauce of
This mechanism is meticulously designed to minimize any potential gap between the ETF's market price, what you buy or sell it for in the exchange, and its net asset value, or NAV.
NAV, right, net asset value.
Exactly. The NAV is basically the real-time per share value of all the assets inside the fund minus any liabilities divided by the number of shares out there.
Okay, so how does this self-correcting engine work?
Right. Let's take a scenario. Imagine an ETF's market price starts to creep up above its NAV. We call this trading at a premium.
Prices higher than the stuff inside is worth.
Essentially, yeah. This usually happens because there's really strong demand for the ETF shares. Lots of people want to buy it, an inflow of interest.
Okay.
When this premium exists, Those authorized participants, the APs, they immediately start a potential profit.
Ah, an arbitrage opportunity.
Precisely. They're incentivized to create new ETF shares. So what do? They go out and buy up the underlying securities that the ETF holds, say, that proportional mix of Apple, Microsoft, Google stock.
Okay.
Then they exchange those actual stocks with the ETF's issuer for newly created ETF shares. And they get those new shares at the NAV.
Which is lower than the market price.
Exactly. Because the market price is higher than the NAV, they can immediately turn around and sell these brand new ETF shares on the open market for a profit.
Cool.
And this action, creating and selling new shares, fundamentally increases the supply of the ETF in the market. Basic economics. More supply tends to drive the price back down towards its NAV. It's a very efficient, self-correcting mechanism.
So if the price gets too high, the big players essentially flood the market with more shares, pushing the price back down.
Well,
And what happens if it goes the other way? If the price goes too low, starts trading at a discount to NAV.
a similar but opposite process kicks in, keeping the whole system in balance. If an ETF starts trading below its NAV, a discount, maybe because of weak demand or an outflow of investor money,
People are selling.
right, the APs again step in, seeing another opportunity. This time, they buy those discounted ETF shares on the open market,
Buying low.
buying low on the exchange. Then they redeem those ETF shares with the ETF issuer. They swap the ETF shares back to the issuer and receive the full value of the underlying securities in return.
Ah, so they bought the ETF cheap, but get the full value of the stocks inside.
Exactly. Since they bought the ETF shares at a discount, but received the full value of the underlying securities, they can then sell those underlying securities for a profit.
Gotcha.
And this act of redeeming shares reduces the supply of the ETF available in the market, which naturally pushes its market price back up towards its NAV.
Wow.
So this constant back and forth action by the APs, it provides essential market liquidity for ETFs. And crucially, it ensures that their intraday market price generally stays very, very close to the net asset value of the underlying assets.
It's amazing.
It's not just clever financial plumbing. It's a brilliant self-correcting engine. It virtually eliminates that old problem you saw sometimes with, like closed-end funds where prices could drift wildly from the underlying value.
Right.
This constant kind of invisible rebalancing is a core reason why ETFs have become so trusted and popular all over the world.
That's an incredibly clever system, almost like a silent guardian keeping everything aligned. It really highlights how robust ETFs can be. So, okay, with that underlying engine understood, let's pivot. Let's turn our attention to what this actually means for you, the everyday investor. Why should you, our listener, care about ETFs? What's truly in it for someone trying to navigate the financial world without getting tangled up?
That's the million-dollar question, isn't it? And the practical advantages are really compelling. They absolutely embody that shortcut to being well-informed idea we talk about.
Yeah.
We can break down the key benefits into, let's say, 4 major categories. You've got powerful diversification, impressively low costs,
Okay.
significant trading flexibility,
Right.
and smart tax efficiency. Each one of these is a powerful reason on its own, but when you put them together, they make a very strong, very accessible case for ETFs in, well, almost any portfolio.
Okay, let's tackle diversification first. You mentioned it earlier, but it feels like such a cornerstone benefit for any investor, maybe especially those just starting out. How exactly do ETFs deliver on that promise?
They deliver instant, broad diversification, which is absolutely critical for managing risk effectively. Think of your investment portfolio like building a diverse sports team.
Okay.
An ETF acts like a pre-assembled team of diversified players, and these players are the individual stocks, bonds, or even commodities inside.
Right.
If you were to just buy one individual stock, all your risk is super concentrated in that single company's performance. If that company stumbles, your whole investment could take a big hit.
Yeah, definitely felt that pain before.
Right. But with an ETF, you buy a single share that represents a piece of a basket that might hold hundreds, maybe even thousands of different securities.
Wow.
This inherently limits volatility compared to holding just a few individual stocks. Because, if one company has a bad quarter, the performance of the many others in the basket can help balance things out.
Can you give a concrete example?
Sure. Take that Vanguard Consumer Staples ETF, VDC again. This isn't just a ticker symbol. It means you're investing in the everyday stuff people always buy, regardless of the economy. Things like toothpaste, soda, groceries,
Recession-proof stuff, maybe?
kinda, yeah, through giants like Procter& Gamble, Costco, Coca-Cola, Walmart, PepsiCo. This structure lets you gain exposure to many different stocks across various industries, different asset classes like bonds or commodities, even specific geographies, like there are country-specific ETFs, maybe MCHI for China.
So you can really target your diversification.
You can. But here's a crucial point. You always need to check the specific holdings of any ETF you're considering.
Ah, look under the hood.
Exactly.
Yeah.
While most provide broad diversification, some specialized ETFs can actually be highly concentrated. You might find one where, say, half its assets are in just 2 or 3 stocks.
Which isn't really that diversified then.
Right. It offers less true diversification than a broad market fund like an S&P 500 ETF. So always check.
Good advice. So it's not just about getting into the market, but getting in smartly, with risk management built in from dollar one. Okay, what about costs? That's always a huge concern, especially for long-term returns.
Costs are a major, major draw. Truly a game changer for long-term compounding, I think. ETFs typically boast impressively low expense ratios.
The annual fee, right?
Exactly. The ongoing annual management fee charged by the fund. And this significant cost efficiency is mainly because many, many ETFs are passively managed.
Meaning they just track an index.
Right. They simply aim to track a specific market index, like the S&P 500, rather than having an active fund manager constantly buying and selling, trying to beat the market. That passive rules-based approach means significantly lower operational costs compared to actively managed mutual funds, which often employ highly paid managers and research teams.
Makes sense. Left human intervention, lower fees.
Pretty much. For instance, Vanguard, a pioneer in low-cost investing, their average ETF expense ratio is an incredibly low 0.05%.
Wow, 0.05%.
Yeah. Which is remarkably like 77% less than the industry average for ETFs, which sits around 0.22%.
That's a huge difference over time.
Huge. And if you compare iShares core ETFs, their average net expense ratio is about 1/10 that of most traditional mutual funds. And these fees, by the way, they aren't like an upfront deduction from your investment. They're just quietly deducted from the fund's total value throughout the year.
So you don't really see it come out, but it impacts the return.
Correct. Plus, a really significant draw for many investors now is that countless online brokerage platforms, think Schwab, Robinhood, Fidelity, they now offer commission-free trading for ETFs.
No cost to buy or sell.
Often, yes, which further slashes your trading costs and makes them even more accessible for, say, frequent trading or investing smaller amounts regularly.
Commission-free trading is amazing. It really lowers the barrier to entry, makes investing feel much more approachable, I think. And speaking of accessibility, how flexible are ETFs for someone who maybe wants to be able to move in and out of positions more easily? Or even apply more, advanced strategies?
Their trading flexibility and accessibility are enormous advantages. As we highlighted, ETFs trade like stocks throughout the entire trading day.
Intraday trading.
Exactly. That intraday trading capability means you can react to market news or changes as they happen. You can buy or sell shares whenever the market is open, rather than waiting for that single end-of-day price, like with mutual funds.
Which gives you more control.
Much more control, and it offers a level of liquidity, the ease of converting your investment to cash quickly that mutual funds simply don't provide. This real-time trading also opens the door to more advanced trading options, things you might be familiar with if you trade individual stocks.
Like what kind of options?
Well, for example, you can short sell ETFs. That allows you to potentially profit if you believe the ETF's value will go down.
Betting against it.
Essentially, you can buy them on margin, which means borrowing money to potentially amplify your returns or losses, of course.
Right, leverage.
You can also set specific limit orders to buy or sell only at a precise price you choose, or stop-loss orders to try and limit potential losses if the price drops.
Standard stock trading tools.
Exactly. You can even use options contracts on many ETFs, like selling covered calls to generate income or hedging positions. And here's another accessibility point that really democratizes investing. ETFs can often be purchased with very low minimums, sometimes as little as $1 for fractional shares, like with Vanguard ETFs.
$1. Seriously.
Seriously. Through online brokers or even robo-advisors like Betterment and Wealthfront, this makes them ideal for new investors or those investing smaller amounts regularly.
That's incredible.
And you can conveniently hold them in tax-advantaged retirement accounts too, like your 401k or IRA.
Good to know. Now, you hear sometimes that because the price changes all day, ETFs are more volatile. Is that true?
That's a common misconception. The answer is generally no. Those intraday price changes just make the investment's movements more visible and transparent. It doesn't mean the underlying assets are inherently bouncing around more. You just see it happening in real time, unlike with a mutual fund where it's hidden until the end of the day.
Oh, okay. Visibility, not necessarily more volatility. That transparency sounds like a big plus too. You can actually see what you own, which must build a lot of trust.
Exactly. Transparency is a cornerstone benefit, I think.
Mm.
The underlying investments, the portfolio composition of most ETFs, are generally published online daily,
Daily. Wow.
or at least quarterly for some specific types, like certain actively managed non-transparent ETFs. But generally, daily. This means you, as an investor, can see precisely what securities the ETF holds at any given time.
So I know exactly what I'm invested in.
Right. It helps you understand why the fund is performing the way it is. And this is often not the case with traditional mutual funds. Fund managers there might only reveal their holdings quarterly or even less frequently, keeping you somewhat in the dark about the exact makeup of your investment.
Yeah, that lack of transparency can be frustrating. Okay, finally, let's hit taxes. Nobody enjoys paying more tax than they absolutely have to. How do ETFs stack up on tax efficiency, especially for long-term investors holding them outside of retirement accounts?
This is a major, major advantage, especially, as you say, for investments held in taxable brokerage accounts. ETFs are often significantly more tax efficient than traditional mutual funds.
Why is that?
The primary reason lies in their unique structure and how shares are bought and sold. Remember that primary and secondary market stuff?
Yeah, the APs and the exchange trading.
Right. With an ETF, most of the buying and selling of shares happens directly between investors on an exchange, that secondary market. This means the ETF sponsor, the company managing the fund, doesn't need to constantly sell off underlying assets from within the fund just because one investor wants to cash out their shares.
Oh, unlike a mutual fund.
Exactly. In stark contrast, when you sell shares of a traditional mutual fund, you're selling them back directly to the fund. This often forces the fund manager to sell underlying securities inside the fund to generate the cash needed to pay you back.
Okay.
And those forced sales inside the fund can trigger capital gains. And here's the kicker. Those capital gains are then distributed to all the remaining shareholders in the fund.
Wait, even if I didn't sell anything?
Even if you didn't sell a single share yourself, it creates an unexpected tax liability for everyone still holding the fund.
That sounds incredibly unfair.
It can certainly be frustrating for long-term holders. With ETFs, because most trading is investor to investor on the exchange, and because of that in-kind creation redemption with APs.
Right, swapping stocks for ETF shares.
The fund itself does much less internal buying and selling that triggers capital gains. So ETF investors generally only realize capital gains when they personally sell their own shares for a profit.
So I only pay tax on my gains when I actually sell.
For the most part, yes. This dramatically reduces those unexpected capital gains distributions that mutual funds often have to pass on. And over the long term, this can lead to substantial tax savings, allowing your money to compound more effectively.
That's a huge benefit. What about outside the U.S.? You mentioned the U.K. earlier.
Right. In the UK, ETFs also have distinct tax advantages. They attract no stamp duty, that's a tax usually levied on buying regular shares. And they can be conveniently included in those tax-efficient individual savings accounts, or ISAs.
ISAs, right. Tax-free growth and income up to a limit.
Exactly, up to £20,000 per year currently. Fantastic vehicles. However, it's absolutely vital to remember that tax treatment can vary significantly. It depends on the specific type of ETF. Leveraged, inverse, commodity, currency ETFs can all have different tax implications.
And where you live.
And definitely where you live and your specific tax jurisdiction. So for this reason, we always recommend consulting a qualified tax professional for personalized advice. Don't rely just on a podcast.
Excellent advice. Okay, that's a lot of compelling reasons to consider ETFs. It really highlights how they've simplified and optimized so many parts of investing. But here's the thing. ETF isn't a one-size-fits-all label, is it?
Not at all.
There's a whole universe of them out there, tailored to different goals, risk tolerances, specific interests. Let's explore some of the main categories, because what's right for one person might be totally different for another.
You're absolutely right. The ETF landscape has exploded since that first SPY fund back in '93. It's really a testament to financial innovation and adaptability. Let's walk through some of the major types, keeping in mind that new, even more specialized ones are always popping up.
Okay, where do we start?
Well, first, there's the really fundamental distinction between passive and actively managed ETFs.
Passive versus active.
Right. Most ETFs you'll encounter, certainly the most popular ones by assets, are passive or index ETFs. Their goal is remarkably straightforward. Just replicate the performance of a broad market index.
Like the S&P 500.
Exactly. Think of them as mirror images of a well-known index like the S&P 500, the NASDAQ 100, or maybe the Russell 2000 for small-cap stocks. They typically hold the exact same securities in the same proportions as that underlying index.
Can you name a few examples?
Here are the familiar ones: SPDR, S&P 500, SPY, the Invesco QQQQ, which tracks the tech-heavy NASDAQ 100, or the iShares Russell 2000, IWM, for small caps. These funds often use what's called full replication.
Meaning they own everything in the index.
Pretty much, yeah. They physically hold 100% of the underlying securities. However, for some really huge indices with thousands of stocks, holding every single one isn't always practical or cost-efficient. So, some ETFs might use representative sampling. This means they invest in a carefully chosen subset of stocks that closely mirrors the index's overall performance. It's like picking a smaller, well-chosen team that behaves just like the whole league.
Still aiming for the same result?
Exactly.
Yeah.
They might hold, say, 80–95% of the index securities and maybe use some derivatives for the rest to fine-tune and hit their tracking objective.
So passive ETFs are basically saying, we're not trying to beat the market, we're just trying to be the market as accurately and cheaply as possible.
Precisely. Then you have actively managed ETFs. These don't just track an index. Instead, you have a dedicated portfolio manager or a team making active decisions about which securities to buy and sell.
Trying to outperform.
Right, aiming to outperform a specific benchmark or achieve a particular investment goal, maybe income generation or risk reduction. Because they involve this ongoing dynamic decision-making and research, they often come with slightly higher fees compared to their passive cousins.
Any examples there?
A popular one is the JP Morgan Equity Premium Income ETF, ticker JEPI. That aims to generate income through active management, using options and stock selection.
Okay, passive and active. What else?
Next, let's explore asset class-specific ETFs. These focus on particular types of investments, like bond ETFs.
Investing in debt.
Exactly. They invest in various kinds of bonds. Could be U.S. Treasury bonds, corporate bonds, municipal bonds. Their main aim is usually to provide a regular income stream.
How are they different from just buying a bond?
Well, unlike individual bonds, they don't have a specific maturity date where you get your principal back. And crucially, they offer much greater market liquidity than trying to buy or sell individual bonds, especially in the often illiquid over-the-counter bond market. It just makes accessing the bond market far easier for everyday investors.
That's a big deal. Buying individual bonds can be really tricky sometimes, and building a diversified bond portfolio yourself. Wow, that's complex.
It really is. Then you have commodity ETFs. These invest in physical commodities like crude oil or gold. Or, often, they invest in the futures contracts tied to these commodities.
Why invest in commodities?
Well, they can be excellent for diversifying a portfolio, maybe provide a hedge against inflation, and holding shares in a commodity ETF is generally far cheaper and more practical than, say, taking physical possession of gold bars and storing them in your vault.
Definitely easier.
Yeah. The SPDR Gold Shares, GLD for example, actually owns physical gold bullion that's stored securely in a vault.
Really? They have actual gold bars?
They do. However, some other commodity ETFs, like the United States Oil Fund, USO, they don't hold physical oil barrels. They own oil futures contracts.
And that makes a difference?
It can, yes. Futures contracts can behave differently than holding the physical commodity directly. This is due to factors like the term structure of the futures market. You might hear terms like contango or backwardation.
Contango. Backwardation. Sounds complicated.
It can be. Think of it like buying milk for delivery next month. If the price for next month's milk is higher than today's price, and you have to keep rolling over your contract, selling the expiring one and buying the new, more expensive one, you're constantly losing a bit of money just in that rollover process. That's essentially contango.
Ah, a built-in headwind.
Exactly. And it can erode returns in commodity ETFs that hold futures over the long term. Backwardation is the opposite, where future prices are lower, which can be beneficial.
Okay, good to know. What other asset classes?
We also have currency ETFs. These track currency pairs, like the euro versus the dollar, or the British sterling, or the Japanese yen.
Why would someone use those?
Could be for speculation on exchange rate movements, or for portfolio diversification, adding exposure to foreign currencies. Or maybe businesses use them to hedge against currency volatility if they have international operations.
Makes sense. Okay, moving on.
Moving on, we have sector or industry ETFs. These are
Hmm.
baskets of stocks that track just one specific industry. Automotive, energy, technology, healthcare, you name it.
So if I'm bullish on tech but don't want to pick just one stock.
Exactly. You can buy a tech sector ETF. Their aim is to give you diversified exposure within that particular sector. Examples might be BlackRock's iShares U.S. Technology ETF, IYW, or the SPCR Financial Select Sector Fund, XLF. They let you invest in an entire industry without the intense research and, frankly, the risk of picking individual winners and losers within it.
Okay. Now, this is where things can get a bit more specialized, right? And maybe for the everyday investor, potentially a little more complex, maybe even riskier.
Indeed. This leads us nicely into geared and specialized ETFs. And it's really critical that listeners approach these with significant caution. You need a deep understanding of how they work. These are generally not suitable for most long-term buy-and-hold investors.
Okay. Caution advised. Like what?
For example, inverse ETFs. These are designed to gain from stock market declines. Essentially, they allow you to profit if you believe the market or a specific sector is going to go down without actually having to short sell individual stocks, which can be complicated and risky.
How do they do that?
They use complex financial instruments, derivatives, to achieve that inverse relationship. However, here's an absolutely critical point. Inverse ETFs are often structured as exchange-traded notes, or ETNs, not true ETFs.
ETNs, not ETFs. What's the difference?
It's fundamental. ETNs are essentially unsecured debt obligations of an issuer, usually a large bank. Unlike true ETFs, which hold underlying assets like stocks or bonds, ETNs don't actually hold anything directly related to the index they track. Their value is based entirely on the issuer's promise to pay the return of the index.
So it's like an IOU from the bank.
That's a good way to think about it. And this means they carry credit risk, the risk tied to the financial health of the issuing bank.
Meaning if the bank goes bust.
If that issuing bank were to go bankrupt, you could lose some or even all of your investment in the ETN, regardless of how the underlying index performed. It's a completely different risk profile than a true ETF, which holds a diversified basket of assets.
Wow, okay. That's a huge distinction. Any other risks with ETNs?
Yes. Related to that, some can also carry redemption or call risk. The issuer might have the right, written into the fine print, to call or basically force the maturity of the ETN early.
Before you plan to sell.
Exactly. And if this happens and the value of the ETN at that moment is less than what you originally paid for it, you could face an unexpected loss.
Okay, ETNs sound like they require extra homework. What about leveraged ETFs?
Similarly complex and risky for most people. Leveraged ETFs aim to return a multiple, say, 2 times or 3 times of the underlying investment's daily return.
Daily return.
Yes, that word daily is absolutely critical. So if the S&P 500 index rises 1% on a given day, a 2x leveraged S&P 500 ETF would aim for a 2% gain on that single day. They use debt and derivatives to get that amplified return.
Sounds exciting, potentially big gains.
It sounds exciting, but here's the crucial insight that trips up even experienced investors sometimes. These products are highly speculative and generally not suitable for long-term holding. Because of a phenomenon called volatility drag, or sometimes volatility tax. Think of it like this. Imagine you have a 2x leverage fund. The market drops 10% on Monday. Your fund loses 20%.
Right. 2 times 10%.
Okay. Now on Tuesday, the market gains back that 10%. Your leverage fund aims to gain 20%. But it's gaining 20% from the lower base it fell to on Monday.
So you don't actually get back to even.
Exactly. After those 2 days, even though the underlying market might be roughly flat, your leveraged fund is actually still down overall. That compounding effect, especially in choppy, volatile markets, is volatility drag. It erodes returns over periods longer than a single day.
So they really don't track 2x or 3x returns over weeks or months.
It's definitely not reliably. They are absolutely not buy and hold investments for an everyday investor looking to build long-term wealth.
So those inverse and leveraged ETFs, they really are tools for very active, very sophisticated traders, right? Mainly for super short-term tactical moves, and definitely not for the average person building a retirement portfolio. What are the biggest mistakes people make with these?
Precisely. They are tools for very specific, often intraday tactical plays, not long-term wealth building for most individuals. The single biggest mistake I see is when everyday investors, maybe lured by that promise of amplified returns, hold leveraged or inverse ETFs for more than a single day, maybe weeks or months.
They don't understand the daily part.
They often misunderstand that the stated multiple, the 2x or 3x, applies only to the daily return. Over longer periods, because of that volatility drag we just discussed, their actual returns can significantly and often negatively diverge from what they expect. It can result in substantial losses even if the underlying market eventually recovers. It's like trying to navigate a long road trip using a map that only shows you the next 10 feet ahead. These are designed for highly experienced traders who really understand the complex daily rebalancing and compounding effects.
Okay, message received. Handle with extreme care, or probably just avoid for most people. What about thematic ETFs? Those sound interesting.
They are interesting and increasingly popular. Thematic ETFs focus on specific, broad trends that often cut across traditional sectors. Think disruptive technologies, clean energy, artificial intelligence, cybersecurity, maybe even the future of food or the gig economy.
Investing in an idea rather than a sector.
Exactly. They allow you to invest in a broad concept. However, the definition of these themes can sometimes be a bit subjective. And there's a potential risk of what some people call AI washing or greenwashing,
Meaning?
where companies might kind of exaggerate their involvement in a hot trend just to get included in the ETF and attract investment. So, as always, due diligence, looking at the actual holdings, is key.
Makes sense. And finally, the really hot topic, crypto ETFs.
Ah, yes, the newest frontier. This is a rapidly growing category that's generated a lot of buzz. We've seen huge developments recently. Spot Bitcoin and Ethereum ETFs, for example.
The ones approved by the SEC?
Right. Approved in January 2024 for Bitcoin, and then initial approvals came for Ethereum in May 2024. These funds invest directly in the cryptocurrency itself, tracking its real-time price.
So they actually hold Bitcoin or Ether.
They do. And they allow you to get exposure to crypto through your regular brokerage account without the complexities, the security risks, or the technical hurdles of directly owning the digital asset yourself, setting up wallets, keys, all that stuff.
That seems much easier for most people.
It is. Now, prior to these spot ETFs, we had futures-based crypto ETFs. As the name suggests, these invest in futures contracts on cryptocurrencies, not the underlying crypto itself.
So like the oil futures ETF example.
Exactly the same principle. A spot Bitcoin ETF is like owning a piece of gold in a vault. It actually holds some Bitcoin. A futures-based ETF doesn't hold Bitcoin. It holds a contract to buy or sell Bitcoin in the future. And that can behave differently due to those term structure issues, contango, backwardation, and comes with its own set of unique risks.
Okay. Any other crypto-related types?
Yeah, you also see things like buffer funds popping up. These aim to offer some downside protection for crypto investment, but usually in exchange for capping your potential upside if the price really takes off. And even the big spot funds ran into funny little issues, like BlackRock's Bitcoin ETF encountering what's called dust.
Dust.
Yeah, tiny, almost untradeable amounts of other random tokens that somehow got mixed in with their Bitcoin holdings, probably from how exchanges handle things. It posed a unique, albeit small, management challenge for them.
Huh. The unintended consequences of innovation. That's a true reflection of how fast these products are evolving, adapting to demand. Okay, we've talked a ton about ETFs in isolation, their features, types, risks, but how do they really fit into the bigger picture? Now that we know the incredible variety, from broad market trackers to hyper-specific themes, let's zoom out. Let's compare ETFs to the other big players, individual stocks and traditional mutual funds. How do they truly stack up when you are making decisions for your portfolio?
This comparison is absolutely crucial because it helps you understand why an ETF might be the right tool for your specific goals, or maybe when an individual stock or a traditional mutual fund might actually make more sense. Let's break it down across several key features, highlighting the distinct advantages and characteristics of each.
Okay, let's do it.
First, just in terms of what they are, fundamentally. ETFs, as we've said, are investment funds tracking a basket of securities or commodities, or an index.
The basket.
Mutual funds are also pooled investment vehicles. They gather money from many investors to collectively invest in a diversified portfolio of bonds, stocks, other instruments.
Also a basket, but different structure.
And stocks are simply direct shares of ownership in a single individual publicly listed company.
Direct ownership, got it.
Okay. Now, when we look at prices and trading, ETFs trade throughout regular market hours, just like stocks. Their prices fluctuate constantly during the day based on real-time supply and demand. And remember, they can trade at that slight premium or discount to their NAV.
Right, the arbitrage keeps it close, though.
Mutual funds, big difference here. They can only be bought and sold once a day after the market closes. All transactions happen at that single end-of-day NAV calculated based on the closing prices of everything inside.
One price per day.
And stocks, like ETFs, trade throughout market hours, with prices fluctuating dynamically based on company performance, market forces, investor sentiment, news, all that stuff.
Okay, so that intraday trading for ETFs really sets them apart from mutual funds. Much more flexibility. What about fees? We know those matter long term.
Fees are indeed a critical differentiator, especially for long-term wealth building. ETFs, as we discussed, generally have lower ongoing expense ratios compared to actively managed mutual funds, largely because so many are passive index trackers.
Right.
They also typically don't charge loads, those upfront sales commissions or back-end redemption fees, and crucially, many online brokers now offer commission-free trading for ETFs, further cutting your costs.
Low expense ratios, no loads, free trading often. Sounds good.
Mutual funds, on the other hand, often have higher management fees. They sometimes include those 12b-1 fees for marketing and distribution. And while some are commission-free, many do charge various loads, which can be a hefty percentage of your investment going straight to the broker.
Potentially much higher costs.
Stocks, well, they don't have ongoing management fees themselves because you own the company directly. And like ETFs, many can now be bought and sold commission-free on various online platforms.
Okay, now what about ownership of securities? You touched on this.
Right, there's a key distinction here. With ETFs, you own shares of the fund itself. The fund, in turn, owns the underlying securities. You, the individual retail investor, don't directly own the individual Apple shares or treasury bonds inside.
You own a piece of the basket.
Similarly, with mutual funds, the fund entity owns the securities in its basket. You own a proportional share of that overall fund.
Also owning a piece of the basket.
But with stocks, you have direct ownership of that specific company's security. You are literally a part owner, a shareholder in that corporation. You get voting rights, etc.
That direct ownership is quite fundamental for stocks. Okay, flip side. Risk and diversification, so important for stability.
Absolutely critical for portfolio construction. ETFs are designed to significantly diversify risk right out of the box. They give you instant exposure to a broad portfolio, multiple asset classes, sectors, industries, geographies. If one holding does poorly, the others can help offset it.
Built-in diversification.
Mutual funds offer a similar broad risk diversification through their pooled investment portfolios. You invest in a wide range of assets with a single purchase.
Also diversified.
Stocks, however, by themselves, concentrate risk entirely in the performance of that single company. To achieve meaningful diversification with individual stocks, you'd need to manually research, buy, and manage multiple individual stocks across different industries, sizes, locations.
Which is a lot of work.
It can be costly, definitely time-consuming, and complex to manage properly.
Okay. Lastly, what about other trading features and general accessibility?
Right, the practicalities. ETFs offer considerable flexibility and are very accessible. They can be sold short, bought on margin. You can trade options on them for advanced strategies. Many allow those tiny minimum investments, even fractional shares for $1, making them accessible to almost any budget. And crucially, they can be easily traded through any stockbroker or online platform.
Easy access, lots of tools.
Mutual funds generally cannot be sold short or bought on margin. They often have significant minimum investment requirements, could be $1,000, could be $50,000. And they're often held directly at the issuing fund company, sometimes with restrictions on how frequently you can trade in and out.
Higher minimums, less flexibility.
Stocks, like ETFs, also offer short selling, margin buying, and auctions contracts. Minimums vary by brokerage, but can be quite low.
Got it. So ETFs really do seem to carve out this unique, appealing middle ground. You get the powerful diversification of a fund, but with the real-time trading flexibility and often the lower costs and maybe closer to a stock, it's a powerful combo.
It is. It appeals to a really wide range of investors, from total beginners to very experienced traders using them tactically.
Okay. We've covered the what, how, and why, compared them. Now let's just touch on some other important details, like how do dividends and taxes work in a bit more detail, what's happening with ETFs globally, and really importantly, what risks do you absolutely need to be aware of? Because while ETFs are fantastic tools, no investment is risk-free, right? Being well-informed means understanding the full picture, warts and all.
That's absolutely right. Understanding these critical nuances is key to being a truly well-informed investor and managing your portfolio effectively. Let's start by expanding just a bit more on dividends and taxes. They can be an unexpected bonus for some ETF investors, and let's just reiterate those key tax efficiencies.
Okay, dividends first. Do I get them?
Yes, definitely. ETF investors can absolutely benefit from company dividends. Just like if you own the individual stock, if the underlying company is held within the ETF, pay dividends.
Like Coca-Cola or Johnson & Johnson.
Exactly. You, as an ETF shareholder, will receive a proportional share of that earned interest or those dividends. These are typically paid out to you, often quarterly. Or you can usually choose to have them automatically reinvested back into the fund to buy more shares.
And what if the fund closes?
In the rare event that an ETF fund is liquidated or closed down, you'd be entitled to a residual value based on your proportional share of the underlying assets after everything's settled.
Okay, now back to those tax efficiencies. Can you summarize the main point again? It seems really important.
It is, especially for money outside retirement accounts. The main point is, most ETF buying and selling happens between investors on the stock exchange.
Secondary market trading.
Right. And the creation-redemption process with AEPs is typically in-kind, swapping stocks for ETF shares. This means the ETF sponsor, unlike a mutual fund manager, doesn't usually have to sell underlying assets within the fund just because investors are trading shares on the exchange or APs are doing their thing.
Less forced selling inside the fund.
Much less. This dramatically reduces the internal capital gains that traditional mutual funds often generate and are legally required to distribute to all their shareholders annually. Remember that issue?
Yeah, getting taxed even if I didn't sell.
Exactly. With ETFs, you generally only realize capital gains, and thus potentially owe tax, when you personally sell your own ETF shares for a profit. This helps avoid those unexpected tax bills and allows your investment to compound more efficiently over the long haul without being prematurely nibbled away by taxes.
That's a significant long-term advantage. But are there tax complexities with certain types?
Yes, definitely. It's vital to remember that the tax treatment of different ETF types, especially those complex, leveraged, inverse, commodity or currency ETFs, can vary significantly due to their structures. And of course, taxes depend heavily on your specific location and tax rules.
So, talk to a pro.
Absolutely. Always consult a qualified tax professional for personalized advice tailored to your unique financial situation. Don't rely solely on general information.
Excellent advice. Okay, it sounds like the tax benefits, particularly in the U.S., can be pretty substantial. But what about our listeners elsewhere? Are ETFs as big or as beneficial, say, in the U.K. or across Europe?
That's a great question, and the answer is a definite yes. ETFs are huge globally, but with some crucial regional differences you need to know about. The UK ETF market, for instance, is one of the largest and most dynamic in Europe. ETFs are widely adopted there.
What are the benefits for UK investors specifically?
Well, they offer attractive benefits like their seamless inclusion in those individual savings accounts, ISAs.
Tax-free growth.
Right, incredibly tax-efficient vehicles, up to £20,000 per tax year, no income tax or capital gains tax on returns. A cornerstone of UK investing. Another big plus is that ETFs in the UK attract no stamp duty, that tax normally levied on buying ordinary shares. So another cost saving.
But can UK investors just buy US ETFs like SPY?
Generally no.
Yeah.
And this is a crucial point for UK and European investors due to regulations, specifically something called UCITS regulations.
Yep.
It stands for Undertakings for Collective Investment in Transferable Securities, basically European rules. Because of these, you generally cannot purchase US-listed ETFs directly in the UK or across most of Europe.
So what's the alternative?
You need to look for UCITS regulated ETFs. These are funds specifically designed to comply with EU regulations, ensuring investor protection and transparency. They can track U.S. markets or other global indexes, but they are domiciled and regulated in Europe, often Ireland or Luxembourg. An example might be something like the HSBC S&P 500 UCITS ETF. It tracks the S&P 500, but it's a European fund.
Got it. So look for the UCITS label. How big is the European market overall?
It's experienced tremendous growth. Assets under management skyrocketed from around $100 billion back in 2008 to over $760 billion by March 2019, and that growth has only accelerated since. It shows huge adoption, not just for long-term buy and hold strategies, but also increasingly for tactical allocation within portfolios because of their low cost, flexibility, and transparency. And there's also a rapidly rising demand for ESG environmental, social, and governance ETFs in Europe, reflecting that growing focus on sustainable investing.
That's really valuable context for our international listeners. Okay, so ETFs have compelling advantages: diversification, cost, taxes, global access. But now let's tackle the elephant in the room for any investment: risk. What are the major risks you, as an investor, need to be really aware of when considering ETFs, especially since they often sound so simple?
It's absolutely crucial. Remember, all investments carry risk. ETFs are no exception. Even though they offer fantastic benefits, they are not risk-free. Being truly well-informed means understanding these potential downsides. Let's go through some key ones.
Okay, hit me.
First, and most fundamentally, there's market risk. This applies to all market-linked investments. ETFs are directly tied to the performance of whatever underlying market or index they track.
If the market goes down, the ETF likely goes down.
Exactly. Their value can fluctuate significantly with overall market volatility. Things like broad economic conditions, geopolitical events, interest rate changes, even just shifts in investor sentiment. They all impact market prices and, consequently, your ETF's value.
Standard investment risk. What else?
Then we have liquidity risk. While most popular ETFs are highly liquid, meaning easy to buy and sell, not all of them have consistently high trading volumes, especially some of the more niche or newly launched ones.
What happens if liquidity is low?
If an ETF has low liquidity, it can lead to wider bid-ask spreads. That's the gap between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask.
So it costs more to trade.
Essentially, yes. A wider spread means higher implicit trading costs for you. It could also mean difficulty selling your shares quickly at a desirable price if there just aren't enough buyers at that moment. And in very rare cases, an ETF could even be delisted from an exchange, which can severely dry up its liquidity and make it hard to exit your position gracefully.
Okay, liquidity risk. Next.
Next is tracking risk, sometimes called tracking error. Most ETFs, especially the passive index ones, aim to precisely replicate the performance of their underlying index. But sometimes, their actual performance might diverge slightly from that index.
They don't match it perfectly.
Not always perfectly, no. This tracking error can happen due to various factors. The ETF's own expense ratio will naturally cause a small drag on returns compared to the index itself, which has no fees. Sometimes, the underlying assets might be illiquid, making it hard for the manager to buy or sell them exactly when needed to match the index changes. Or there could even be temporary disruptions in that share creation and redemption process with the APs.
So my return might not be exactly what the index did.
It might be slightly different, usually by a very small amount for well-run funds, but it's something to be aware of. It can impact your actual returns relative to the index's theoretical performance.
Got it. What about those ETNs again? Specific risks there.
Yes, let's reiterate the credit risk specific to ETNs, exchange-traded notes. Remember, they are fundamentally different unsecured debt from an issuer, usually a bank.
The bank's IOU.
Right. Unlike true ETFs, they don't hold the underlying assets. So if the issuer of the ETN defaults or goes bankrupt, you could lose some or even all of your investment, regardless of what the tracked index did. Your investment safety is tied directly to the financial health and creditworthiness of that issuing bank.
That's a big one. And the call risk.
Yes, related to ETNs, some also carry redemption or call risk. The issuer might have the discretion, buried in the prospectus, to call or accelerate the maturity of the ETN before its stated end date. If they do this when the ETN's value is less than what you paid, you could be forced to lock in a loss.
Okay. Any other big categories of risk?
Well, there are always other specific risks depending on the ETF type. For cryptocurrency ETFs, you obviously face the inherent, often extreme volatility of the crypto assets themselves. Plus, there are broader risks related to potential fraud or market manipulation in the underlying crypto markets, or maybe operational issues with crypto trading platforms or custodians.
High risk for high potential reward, maybe.
Potentially, yes. For commodity ETFs that use futures contracts, you have those specific market dynamics we talked about, term structure, contango, backwardation, that can impact returns independently of the commodity spot price. And historically, it's worth noting, ETFs face scrutiny after events like the flash crashes in 2010 and 2015.
What happened then?
During moments of extreme market stress, the prices of some ETFs appeared to briefly come unhinged from the value of their underlying assets. Trading mechanisms got overwhelmed. This led to increased regulatory attention and some reforms to market structure.
So things can get weird in extreme conditions.
It underscores the vital importance of thoroughly researching and understanding the specific objectives, the underlying holdings, and all the associated risks of any ETF before you put your hard-earned money into it. No shortcuts on due diligence.
That's a crucial and really comprehensive breakdown of the risks. It definitely drives home the point. Understand what you own, no matter how simple it seems on the surface. Okay, before we wrap up our deep dive, it's always fascinating to look back. How did something so revolutionary, so widely adopted, actually get its start? Let's take a quick glance at the origins of ETFs and maybe who the major players are shaping this landscape today.
It's quite a journey, isn't it? For a financial product that seems so, well, ubiquitous now, ETFs didn't just materialize overnight, they were precursors. Back in 1989, index participation shares, or IPS, were launched in the U.S.
IPS. Never heard of them.
They were short-lived. Ran into some legal challenges related to whether they were futures or securities, but they planted a seed. However, a similar product, the Toronto Index Participation Units, or TIPs, successfully launched on the Toronto Stock Exchange in 1990, and they actually gained traction.
So Canada got there first, really.
In a sustainable way, yes. The success in Canada really paved the way for the U.S. to try again, leading to that pivotal moment that truly redefined investing for many.
Which was SPY.
Exactly. The first widely recognized U.S. ETF, the SPDR S&P 500 ticker SPY, affectionately known as SPDRs. It was meticulously designed by a team, including Nathan Most and Stephen Bloom, under the strategic direction of Ivers Riley at the American Stock Exchange, and crucially, with significant legal and regulatory heavy lifting by Kathleen Moriarty, often called the godmother of the ETF.
Wow, quite the team effort.
It really was. SPY officially launched on January 22, 1993. It tracked the S&P 500 index, and it quickly became the largest, most heavily traded ETF in the world for a long time. This marked the true beginning of the modern ETF era, fundamentally changing how investors could get easy, low-cost access to broad market exposure.
So a Canadian innovation really did inspire the U.S. market. That's a fun fact.
Yeah.
A testament to how financial ideas can cross borders and evolve.
Indeed. And after SPY's groundbreaking success, other major players quickly saw the potential and jumped in, leading to really rapid innovation. Barclays, for instance, launched something called World Equity Benchmark Shares, or WES, back in 1996.
WBS.
Yeah, they later evolved into the hugely successful iShares, MSCI Index Fund shares. These were among the first to give investors really easy access to foreign stock markets through an ETF structure.
Opening up international investing.
It's exactly. State Street Global Advisors, the folks behind SPY, they built on their success. They launched Sector SPDRs in 1998, focusing on individual S&P 500 sectors like technology or financials, and also the Dow Diamonds, ticker DIA, tracking the Dow Jones Industrial Average.
So slicing the market different ways.
Right. Then in 1999, the influential Qs, the Invesco QQ, ticker QQQ, were launched to replicate the tech-heavy NASDAQ 100 index, just in time for the end of the dot-com boom.
Timing is everything.
The iShares brand, which started with Barclays but is now the flagship ETF brand under BlackRock after they acquired that part of the business, saw absolutely massive growth. By 2005, iShares held something like 44% of all global ETF assets under management.
Wow, nearly half the market.
A clear sign of their dominance and how quickly investors adopted these products. And then in 2001, the Vanguard Group, always a major advocate for low-cost index investing and the individual investor, entered the ETFs market. They launched their Vanguard Total Stock Market ETF.
VTI, yeah, that's a big one.
Huge. It essentially aims to own every publicly traded stock in the entire U.S. market. Ultimate broad market exposure at a typically very minimal cost.
And it seems like the innovation just kept rolling from there, didn't it? Constantly finding new ways to package and deliver market access.
Absolutely. The evolution has been relentless. We saw the first bond ETFs introduced in 2002, finally giving easy, diversified fixed income exposure. Currency ETFs followed in 2005. The first leveraged ETFs, though specialized and risky, as we discussed, emerged around 2006. Actively managed ETFs, trying to combine the best of mutual fund management with the ETF structure, launched in 2008.
And now crypto.
And now, most recently, the significant approvals and launches of spot Bitcoin and Ethereum ETFs in 2023 and 2024, really opening up the cryptocurrency market to traditional investors through familiar channels. This rapid evolution just showcases how adaptable and responsive the ETF structure really is to new market demands, new technologies, changing investor needs.
It's incredible. Who are the giants today? Who are the biggest issuers?
Well, today, the ETF landscape is dominated by several key issuers, true giants in the financial world. You'll constantly hear names like BlackRock, primarily through their extensive iShares product line.
Right. iShares is everywhere.
Vanguard, famous for its low-cost, broad market funds appealing to long-term investors. State Street Global Advisors, the pioneers with their SPDRs like SPY, Invesco with QQQ, and many others. Charles Schwab has become a major player too, especially with commission-free offerings. These firms manage literally trillions of dollars in ETF assets globally, and continue to shape the industry, constantly bringing new and innovative products to market.
What an incredible journey for a financial product that has truly transformed how millions of people, from huge institutions right down to everyday individuals like you listening, invest and manage their wealth. So, just to recap our deep dive today, exchange-traded funds, ETFs, they offer this unique and really powerful blend. You get instant diversification through their basket of securities. You
Mm,
get incredibly low costs, usually,
typically, yeah.
and you get the real-time trading flexibility of individual stocks. They are a modern, highly efficient tool for your investment portfolio. They provide a cost-effective, accessible way to gain exposure to a broad basket of securities, even with a limited budget. They've really made sophisticated investing far more approachable for everyone, haven't they?
They absolutely have. And that's really the core takeaway here, I think. ETFs have fundamentally democratized access. Access to markets, access to investment strategies that were once solely the domain of sophisticated institutional investors or people with massive amounts of capital. So as you think about your own financial journey, as you think about building a portfolio that truly aligns with your goals, your timeline, your tolerance for risk, consider how this innovation, the ETF, might empower your path to becoming a truly well-informed investor. The market is constantly evolving, and these products will undoubtedly continue to adapt, continue to innovate, creating new opportunities for smart, engaged individuals like you. They offer more tools than ever before to help you build the financial future you envision.